This is our Q4 newsletter, and it's got a lot of graphs in it, and I'm going to run through this, and it may get long. I'm going to do my best, but I really think that the verbiage, my communication on what we were thinking when we put this together is going to be very, very helpful. So I'm going to make myself smaller. I'm going to make myself smaller. I'm going to make myself smaller. For those of you, we kind of do this in much more of a podcast format. So if you're driving down the road, don't take your hands off the wheel. I always get a kick out of saying that. Now, on to seriousness in the essence of time. So what I'm going to do is I'm going to verbalize the graphs. And this newsletter is the third consecutive unique newsletter. When all the stimulus stuff came out, we just shredded that first newsletter and went through discoveries on that. Then the next newsletter, mid-news part of the year, was all about the research that was done. And this is looking back. Things are a little calmer, but this is now looking back at what's going on, what may be happening in the future. So here we go. And I've covered this all in a lot of graphs. For those of you that are listening, I am on page 1. This newsletter is unique in that it's just going to flow. So hopefully those readers, some of this stuff gets confusing, but those that are reading it can just continue reading it page by page. Okay. Those that are you in listen-only mode, continue to be safe. On the first page, I have a graph from our friends at Kvale, which is a service that we've been testing throughout the year. And basically, it pulled together indexes from the top to the bottom of the move when COVID broke out. And it was really stunning because we had, with the S&P dropped 33%, the DAX dropped 35%, the Russell, the small company index, United States small company, dropped 40% in 27 days. And so as we look back on that, that was stunningly fast. And maybe that was a good thing because it recovered quick. We're going to talk about that a little bit more. But I wanted to point out, we have long memories like elephants. This is the third time this has happened, this quick move. We had a hissy fit. Those of you that are listening, we basically had a hissy fit back at the end of, let me get the exact dates, at the end of 2019. And what it was when the Fed started raising interest rates. And we dropped almost 20%. And so, I'm sorry, that's at the end of 2018. That was the Fed was raising, 2019 we were fine. The Fed was raising rates and the markets took note of it and really just jumped off a cliff. And we dropped down 20%. And if you look back even a little bit earlier in 2018, we had another 15 to 20% drop. What I'm saying on this and what I wanted to get across is we may be due to trading, we may be in a faster type of market. And so we hope we're not, but normally drops of this magnitude take 12 to 18 months, at least 6 months, not days. And so we're keeping an eye on this. The most important thing to come from this is our fixed income to equity must be appropriate. If you get that out of whack when we're moving this, when these markets are moving around so fast, it'll throw us out of our comfort zone. Okay, so markets drop precipitously. We now know that they've moved back, and again, we'll talk about that later. But as the markets were dropping, the Fed did something uncanny. Those of you that are in listen-only mode, I'm on to page 2, the chart at the lower. This is a chart of the Federal Reserve Fed funds rate. And when everything started really breaking out, the Fed dropped rates to by a full, they just dropped them rock bottom. I mean, it was a full 100 basis points all the way down. We were up at late 2019, we were up around 2.5%, and now we're back to basically zero. So normally they move these in 25% increments. They just drop the hammer. But wait a minute, that wasn't enough. Now remember, we got to backpedal into March, April timeframe. The sky is falling. And we proclaimed, hey, the market participants may look through this, but the Fed didn't stop there. Those of you that are in listen-only mode, we're on page 3, and I'm showing the Fed's balance sheet. I really thought these graphs came together very well. In the 7-8-9 crisis led by Ben Bernanke, he did something at that time that was unprecedented. He pulled out the bazooka, and he laid on about $1 trillion worth of debt through the capital markets. Unprecedented. Now, we did have some continued QE after that to move it up. Those of you that are in listen-only mode, I'm just following along of a graph from the St. Louis Fed of the Fed's balance sheet. But they started tapering this. The pandemic hit, and they pulled out the bazooka, but they pulled it out ×3 and counting. So they did triple in way, like 1/3 of the time. That's how much money they're putting into the system. So naysayers may say, "Oh my goodness, this is going to cause problems. This is going to, the dollar, inflation, all of this." Well, we'll talk about inflation. The good news about this is those of you that are, again, in listen-only mode, I am on the next page. I'm on page 4. And this is from our friends at JP Morgan. This is the Fed, the Bank of Japan, the ECB, and the Bank of England. We're all doing the same thing. This graph just worked, in my opinion, beautifully because it shows that we're not alone in this. Be it right, be it wrong, everybody's doing the same thing. And so that'll be very hard to isolate one country and say, well, there's a problem. There's something that's going to come of this. And it does look that this will continue. We expect it to continue until things settle down economically across the globe. Okay, now I'm going to the next graph. And this is where we have, going back, we're on page 5, and I'm showing a future PE. So the forward PE ratio. In March, we came out at the end of March, we came out and said, listen, investors would likely look through this. This is self-induced. This has happened quickly. And we did. And we were happy about that. And in true Wall Street format, we got overzealous. And I found this graph, and it's not meant to scare, but it's showing valuations similar to 99. Now, we're in a different period of time, and I go into the differences and the things in 99, but we went too far. Now, we're correcting that some. I have to write this newsletter at earlier on in the month, and so I've got data that is slightly stagnated, and so we have pulled back a little bit, but we likely are ahead of ourselves. Our hope is that we grow into our oversized genes. That could mean we go sideways, but the valuations are rich. We have gotten ahead of ourselves happily, but let's not get too carried away. Now is not the time to take risk. Extra risk. It is always the time to take risk, but not to be cavalier because our valuations are high. We go into, okay, what could cause, and I go into a personal story that I'll let you read in the newsletter. What actually could cause the problem of the capital markets? Well, first of all, I'm now on page 6, and I'm looking at a graph that's called the advanced decline line, and healthy markets move up with all participants, all as in big companies, large companies, and small companies participating. What has happened in our move, in this latest move, and I go into this in this second graph below, is that at the beginning, in the May, June, July timeframe, the capital markets were all recovering. They've gotten a little bit pointed. I know this is going to be confusing, but what happened is only a few participants. In this case, it was big company tech. A few large company tech continue to move the markets up. We need that to flatten out and not be so much of a, call it a mountain. It has started doing that. But what that leads itself to is if we have some sort of issue, and I go into this, what would make the Federal Reserve suddenly start raising rates? Well, it would be inflation. And I talk about the trimmed mean. Those of you that are watching, or those of you that are in listen-only mode, I'm at the bottom of page 6. All the horsepower that we're putting into the economy, 3 times what we did before, could it lead to inflation? Yes, it could. And if inflation occurred, then the Fed would be forced to raise rates. One thing they are on record of saying is that they're going to let inflation go over their 2% target. But if it gets over 2%, let's say it jumps to 2.5 or 3, we're going to see market participants anticipate the fact that they'll start raising rates. And it's just a shot across the bow. I just want us to remember that things happen. And at the very end, I'm going to scroll on down. At the very end, I'm at the bottom of page 7. I've got the exact PCE, which is the trend mean, is basically the outliers are dropped off the regular CPI index. For what it's worth, we just need to keep an eye on this. I'm not saying it will happen. I'm just saying it could happen. And that's another reason not to be too cavalier and take extreme risk at this period of time. Lastly, we know it's an election year. And we have been asked multiple times what's going to happen. Nobody knows. Nobody knows for certain what the election is going to be. More importantly, nobody knows what for certain the capital markets reaction are going to be to that election. I will say this: capital markets, they're not political. Capital markets are most focused on the economy. There could be headwind and tailwind depending on what occurs, but it's not imminently dire one way or the other. So I know this has probably gotten a little long, and I hope that this brought some granularity. These graphs, I got very, very lucky in doing my research on this, and I felt like it came together. Those of you that are watching or listening, I'm going back to the very beginning of the graph of the newsletter. I want to thank everybody for listening. I feel like this has probably gotten a little bit longer, but I just wanted to close, and we're rolling into the final months of the year. October can typically be a little dicey. Mutual funds oftentimes are closing out their books. We've had a couple shots across the bow of how fast these capital markets move. So let's take heed, and I hope this was helpful. We'll talk to you in 2021. Thanks.